Welcome to Searching Smarter with Selby Jennings, the podcast for hiring managers and professionals navigating the job market within financial sciences and services. Whether you're searching for top talent to grow your team or considering your own career move, this podcast will help you do so with confidence. I'm your host, Jesse Scaff, Global Client Director for Faden International's Financial Sciences and Services brand, Selby Jennings.
Citadel was an amazing opportunity. Everyone they hire, they essentially say, this person needs to have the potential to be the next PM or the next head of this thing. So they don't just hire for a given skill set, they hire for someone who can learn and go up that ladder.
What is a way for the next generation of talent can set itself apart?
It all starts with, that's the secret weapon, right? That's the key. Everything has a process. You evaluate the process, look at the data, you figure out how can I do it better? How is someone else doing it differently? How can I incorporate that? You get to people who will say, hey, I made this much in a stock, or I had a great idea. I'm like, all right, but let's get into, that's the output. Let's get into the input in the process.
Investing in AI as a strategy, underhyped or overhyped?
I think
Today, I'm speaking with Doug Garber, passionate investor who has experience at some of the biggest names in the hedge fund industry. We discuss the importance of process as an investor and what that means from stock picking to conviction to following a hunch or using data. We also chat through the new and various career paths to being a portfolio manager and whether the sell side is the best or only starting point for a trading career, and how aspiring traders or financial services professionals can stand out in today's market. Doug also runs his own podcast, Pitch the PM, where he and his guests talk about investment ideas in specific stocks. So anyone passionate about investing like Doug should give that a listen. In the meantime, here's my conversation with Doug on Searching Smarter. Hey, Doug. Good to see you. Thanks for being on.
Hey, Jesse. Good to see you. Thanks for having me.
Of course. I'm excited for today's chat. Without further ado, I just want to turn it over to you and have you tell us a little bit about your experience, your career, and kind of maybe how you ended up in financial services.
Ever since kind of middle school, high school, I was interested in, my dad always had 10Ks lying around on the coffee table. And in high school, I would do this kind of Fed challenge where you'd go into the Federal Reserve and, do a mock FOMC meeting and pretend you were them and what decision you would make. So I kind of liked that economic, social science reasoning. Then I got into Tulane and didn't really figure out what exactly I wanted until my senior year. They had this course called Birkenroad Reports, where you find local stocks under rocks. And you write essentially a sell side initiation report. They have a little conference. These are small local stocks that people aren't covering. I'm still in touch with some of those management teams today, 20 years later. I've covered them throughout my career. And I just really like how all the pieces fit together and how you can kind of research one aspect and just put it all together. So I enjoyed kind of thinking about it like a puzzle. I was fortunate that led to an internship at a local broker-dealer called Johnson Rice in New Orleans. I ended up interning for someone there. And from there, it was actually a recruiter had found me on the campus network, the equivalent to Handshake or something today, and put me in touch with someone at FBR, another Tulane alumni. And they wanted me, they were looking for an experienced hire, which was a little aggressive for where I was, but I had the internship. I had a good mentor in the beginning. So I went up to DC after my master's degree, and I did equity research on this, on the sell side, which to me was great because I loved the research part. Didn't really know that much between the sell side and the buy side at that point. And the truth is, as an associate, there's not that much difference until you really become more senior and you become more of a marketing analyst. Yeah, so I was there for 5 or 6 years. I really enjoyed it. It was in DC. It was actually kind of an odd time because it was right as the housing and mortgage-backed securities were all collapsing, and this firm had another branch that was very deep in it. They had split it off early so that they survived, but it was, 10% layoffs every 6 months for a couple of years. That was starting in 2007, essentially when I started. Luckily, I was brand new, so that they I wasn't a target there.
No last in, first out.
No, I think a lot of it is at that point every senior would kind of have one associate. If the senior had two, they'd be like, all right, no one has two anymore, right? And then you get rid of it. So it was just
fair, good,
matched up sort of. Or if they got rid of your senior and they didn't have somewhere to put you, so it's just if you were with kind of someone who was well regarded, you were kind of fine. So I enjoyed that. I dug in deep, learned to model, learned to really dig in. He was an engineer by trade, so a lot of in-depth modeling and research, trying to get an edge and add value for the client and really figure out an industry better than anyone else, kind of super focus. So I actually started there in the energy sector. By the end there is kind of associate, senior associate, then AVP. And then by the time I was a VP, I was actually more in the transport sector. And I was a marketing analyst there, and I was doing shipping. So there actually I consider myself last in, first out, because I was probably like the 30th shipping analyst at the peak there. And then I ended up leaving 6 months later. Another recruiter had actually called me, and I'm like, well, I just got this promotion. They promoted me early. They really believed in me. I developed a relationship as my first job. I really actually felt bad about leaving because I was really committed to, I think I was maybe 26 and I was a senior analyst. So I really wanted to kind of prove it and everything. But I ended up going to a firm called Dahlman Rose, which was another sell side kind of boutique research shop that focused just on energy and natural resources and the whole kind of supply chain and industrials. Kind of that part ended up getting bought by Cowen to kind of merge and become bigger. And I moved. I worked for this guy who was used the director of research at Salomon Brothers at one point. Then he went over to Lehman and Barclays when they kind of did it. So me and II for decades, he was very, very well known. And I kind of brought me over to be his number two. And I knew it was a much better opportunity because he knew everybody. He was just knew everyone on Wall Street. And, I would have access and, I was go to all of his dinners on a plane, to every single.
Great exposure.
Yeah. So that's important, and I think it also got me from DC to New York and got me in a more relevant sector. It's funny, when I was in the shipping sector, I went on the transport side. So then I went back to the energy world. And I worked for this guy who literally knew everyone. He had like a 6-person team. He had like 3 or 4 associates. I was his other kind of covered the small caps. He covered the large caps, and working under him, he had mentored so many other people. And he had such a good attitude, and just his meeting everyone was really amazing. I did that for about 2 years, and it was good because I was really focused on the research part. I wanted to make big calls. I wanted to be right. And when you get to that part of your career, it's more about being popular, getting corporate access, getting people to vote for you. So getting them to come to your conference, things like that. And I really wanted to be focused on the research, not the marketing. But when you're incentivized to put together a great calendar, and your sales guys are the ones who tell your, DOR and how good you are, they'd rather meet with the CEO of your company than you. And you're not going to get the CEO of your company on the road if you don't have nice things to say. So I kind of loved research, but I didn't really want to be a marketing analyst, as you would call it. So, my goal, this was always a stepping stone for me to, I always wanted to go to 0.7 SAC at the time, which is now 0.72, or Citadel. That's where the best and the brightest, that's where that was the seat I wanted. And so this got me to New York. And then this analyst, he would go to dinner with the PMs, right? So the PMs would actually take time to go to dinner with him. He knew everyone. So, and one of the, PMs at Citadel Surveyor, we had gone to dinner. He liked me, and I think we had developed a little bit of a relationship, right? Because I was kind of in the models and the weeds, and then about a year and a half into being there, they started to kind of contact me. And what happened is that PM, one of his best friends, another PM there, he had an opening, so he told his friend that, hey, you should talk to this guy. He's sharp, he's young, he's hungry. And, he's really on top of, the numbers, and he's in the weeds. He's really, you should give him a look. So I ended up moving over to Citadel, which I was super pumped about. That was kind of the exact job I wanted. It was kind of a harder and longer path than I would have originally, because I didn't go to any of the Ivy Leagues or anything like that. I didn't go, usually they're recruiting from, GS or the tier banking program, things like that. I kind of knew I had to work much harder and just be the best at what I was doing. And that's the path I went, which was a little more unconventional. I think they tended to recruit more from, the standard route was, you do your 2 years of banking and then you get recruited off. Because that's kind of where the top finance folks go, at least from the Ivies. Tulane got recruited from more like the Bear Stearns and the Piper Jaffrays, where they wanted the hungry people. That was kind of people that were recruited at Tulane on campus, at least. That was my path to Citadel. And once you're there, I kind of describe my time there in kind of two phases because I had two different PMs that I worked for.
Okay.
And that's pretty common, right? And I really liked the guy I worked for. He was a great mentor. When people ask me who do you really respect of the people you work for, I would talk about this guy, Kyle, and he was actually in Dallas. So I flew to Dallas every week for about the first year, essentially.
Oh, wow.
So yeah, and it's just at that point in your life, I can do that, and we decided we weren't going to move. So either I was either on the 6 a.m. flight or coming back, but
Sheesh.
You need to be all in the beginning to it's full. You got to be fully focused on what you're doing. So actually, the plane rides were fine too because I actually would just read. Actually, ended up reading all the Warren Buffett letters. I read one per trip from the shareholder letters for 50, 60 years. And what kind of informally happened is Citadel had their global equities platform. They started their surveyor platform, and then a lot of times as they were building that, they would they just said, all right, they would find the most senior or two good analysts from 0.70 SAC at the time and say, all right, come over here, your PMs. That happened in a few different industries. I saw that happen later in industrials. Yeah, so I worked for him and I learned the processes that he learned from his mentors. That were, what was from doing good research to how do you make a bet?
Yep.
What is your process for gathering information and realizing what is your view versus the street's view and what's your path to getting paid? And what's your probability of getting paid up or down, and what are the signposts, and are you being intellectually honest along the way? And I still remember this, when I started, he gave me a few page kind of instruction manual, I guess I'd call it. The only thing that he wrote 3 times in all caps was communicate, communicate, communicate. So a lot of the businesses, it's very similar, I guess, a lot of other businesses is how do you communicate, right? He's the decision maker. He's got his finger on the mouse. How do I communicate the knowledge that I'm out there gathering 24/7, put it into the framework that he trained me on, right? And for the first 6 months, he goes, all right, you're going to do this right up in this process until you learn it. And then, after that, he kind of would say, all right, he's done the work. He's in that framework, even though he hasn't actually put it into, the 2-3 page document. So, and that was, that was my intro to investing, right? So I had a good research, a good Excel, good modeling, good management relationships, good industry knowledge, but looking at all of that and saying, hey, how do you form a bet and make money and have confidence in it? And it's all about trust in the process. And that process was something that he quantified and he put together, but that was based on things that he had learned. And I just did the same thing, with Pitch the PM is I put together the 10-step process that I've refined it to. So it always gets refined over time based on what people are learning, and based on the mentors and the sectors you have. And then the second phase at Citadel, while I was at Citadel, it was also a very different investment style. So what happened is about halfway through my experience at Citadel, they switched the head of surveyor. They brought in someone from global equities that was saying, all right, much more risk focused and much more team structure focused. It was more analyst central versus PM central. Whereas before you were kind of pitching your PM and he would size it based on how he would want, and you still had your paper book, but he would do the, you didn't convince him, it didn't count. In the new model, you would have kind of a few different risk takers and they'd be running part of the capital. The PM could still run a center book on top of it, but they would push decision-making and risk-taking down to the most capable, lowest person on the pole. I mean, that's something Ken has said a lot is, we have decision-making done by the most capable person, so they push it down. So more people are making decisions. It's not all up to the CEO. It's very fragmented. And it's also, then we were very focused on the risk model and running our IDEO.
Quick one for you, just maybe in case there are inexperienced listeners or those who are considering breaking in and without a ton of experience yet, and maybe aren't familiar with all financial services jargon. When you say IDEO, you mean?
Idiosyncratic risk is essentially your alpha or your risk model. You'll have a limit. So what you're trying to do there is you have your fundamental bets, but there's also these other, call it bets in the market that the quants create, whether it's long-term momentum, short-term momentum, value, growth. And those aren't those are considered non-alpha. You don't really have skill in predicting that as a fundamental analyst. So you want to kind of eliminate that from your book and make sure you're making bets that are purely alpha, which is any stock. It could be how much of the move. It could be 40%. It could be 20% of the stock's movement is considered alpha or idiosyncratic, which means it's not explained by a quantitative factor. So alpha is really just another word for residual or what's left over. You could go down that hole for a while.
That's helpful though. Thank you.
And it's a good skill because, Citadel was really big on it, and now all the other shops are also big on it. But again, it's later down the path. You really want to learn your Excel. You want to learn your companies. You want to learn your fundamental stock pitching process. And then eventually when you get into, hey, I want to manage risk and be a portfolio manager, then you start to dabble in the quantitative factors. It's kind of like an overlay, right? You might have a 5% position, a bet on one stock because you fundamentally have a thesis. But if you add up all your positions in your book, you don't want to then have a 30% position in some factor that you're not actually trying to make a bet on. Right. So it's just kind of a risk control. Citadel was an amazing opportunity. I mean, the great thing there is you're always surrounded by great people, very ambitious people, type A personalities. And, I had been there for a while, and I was starting to build a team to spin out and do my own team there. It's just the great thing about, Citadel is the cool people they put in front of you to hire your associates is just such a high caliber.
Yes.
And they raise the bar. They have such a high bar that they put the BD and HR screens through. And it's not just up to they hire an analyst, it's up to BD and HR. Like everyone has to say, hey, this is a great person for this team and also a great person for, everyone they hire, they essentially say, hey, this person needs to have the potential to be the next PM or the next head of this thing. So they don't just hire for a given skill set. They hire for someone who can learn and go up that ladder over a while. It was a great place to learn. I think some of the best advice I got was from the former COO of Surveyor. He said, stay as long as you can. The experience you get and the people you work with is amazing. I didn't take that advice. I decided to go to Millennium and start my own thing. And I started, it was called Katahdin Capital. Tried to create my own little brand. I tend to have a little bit less turnover than the traditional pod shop. And I didn't want to be necessarily associated. Well, I tried to have a little bit of a different reputation with the management teams because I had known them. I didn't want them to think I was trading as much as investing in the name. So I tried to have a different brand. At the end of the day, when you go to their meetings and Millennium's paying the bill, they aggregated, they gave the street together. You have one meeting for all of you. It doesn't really matter as much. In the beginning, when I would set up my own road shows and just go meet the companies, I did that when I started. I just flew across all the major cities and met with all the, the IRs and CEOs and said, hey, this is what we're doing. And then they're like, oh, hold on, this is also what Millennium. So you try and get your own access. And Millennium it's also an amazing place to work. It's much more decentralized. It's kind of like, literally I had lunch with the head of the equities platform. He goes, good luck. Let me know how I can help. They're your investor and they do provide you support. Now they are starting to help you with the hiring, and they have all sorts of other kind of support functions and they to check in that they've been building out over the last few years to kind of close the gap. And they've done, a great job of that by kind of put it in that middle management. Yeah. So you kind of say, all right, good luck, go hire. And it's your decision. You can actually make the final decision. They'll give you a recommendation, but it's your call at the end of the day. Whereas at Citadel, they'll say, no, sorry. And they have to go through a third party kind of assessment too. And, I was ramping up my team. It was essentially the same business model. It was going to be kind of half energy, half industrial. Hiring was a little trickier than I thought. I was able to convince a friend from Citadel that he should come work over at Millennium with me. So he did, which was super exciting because he was a top performer there. And for him to come over, that was great. And I was able to do it because I had now been there. I remember the time, a year or 18 months to have him come over past the non-solicit period. And then I had a different industrial guy because I want someone with more experience. And then what they ended up doing is I became a senior PM and they became PMs, and I delegated some capital to them as well. So it was, now it's like the Citadel model where you have a couple different risk buckets. Then I decided, all right, it's COVID, I'm at home. I ended up going to do investor relations at another company. It was actually an Israeli company, a little bit of tech. And when we were at Millennium, you have a lot more freedom. So I was doing some other capital markets and other, we did a lot of kind of SPACs and other stuff as well, and more exposure there. So back then I went into the tech world, which was fun for a year. It was kind of the back half of the COVID bubble. This company had gone from, growing 10, 20% to 80 to 100%, and then back down to zero. So, and the stock went from being valued at 10 times revenue to call it 10 times EBITDA. So they weren't so happy when their stock price went from 90 to 30.
Who is?
Yeah, exactly. Who is? But I loved it. It was just an amazing experience. It was great people. It was very entrepreneurial. I think everyone in finance on Wall Street should spend at least 1 year in the kind of IR FP&A function to see how companies actually do the forecasting and messaging. And it's just eye-opening, because when you're in your seat on the sell side or the buy side, you say, oh, well, the company must know more because it's their company. They're on the inside. They the benefit of the doubt. When in reality, they don't necessarily know that much more if they don't have, a lot of businesses don't have visibility, right? If you have contracts and backlogs, sure. But if you're kind of a week-to-week business, they don't necessarily have that much visibility. So it's this eye-opening, and how they do the whole earnings process and the messaging, and how we literally spend a month gathering questions and then writing answers for the CEO, CFO of how they could, deflect. It was fun. I mean, every company is a little different. Some will just kind of tell you how it is, and some will try and pivot a little bit with the answer and avoid and evade. But it was a great experience from that perspective. I say I got like 5 years of, experience in a year there. And then since then, I've been just doing my own investing, and I was looking for businesses to buy. And then I decided to podcast this with some of the conversations I was having with some of my other friends. I'm like, well, this would be great. Why don't we do a podcast and kind of talk to folks about our highest conviction ideas? And then it became a lot more work to actually put it in motion than to say, hey, let's just chat about the way we were chatting when we were just doing our own investing and stuff. And it's been fun. It's been getting in touch with a lot of former colleagues. There's been traction from everything from, we do this job board. We have, I've had people, ask us to run money for them. And I was involved in a large kind of independent sponsor sort of takeover last year. I spent about 4 or 5 months consulting on that. So that was a great project. I never really thought I'd be a independent sponsor on the banking side. I won't do it again, but it was fun. And yeah, so now I'm just really doing the podcast. And the thing I like the most about it is I get to research the stocks that I want. And I don't need to have 120 stocks in the book. I don't need to have 40, 50 bets a quarter. I have 20 stocks. I have a few high conviction ones, and I'm kind of transitioning from the way I was trained from pod investing, which at the end of the day, was great research practice, but the portfolio construction is now very different. So I spent the last 2 years also studying some of the other people, more concentrated value investors. Obviously, everyone from Buffett and Munger to Pabrai and Spear, Greenblatt, people who had outsized returns by focusing on concentration, which is the complete opposite of what we were doing at the other shops. We were trying to have flat portfolio construction and as many bets as you can, and just hit, 50, 55% with a 50, 60% slug. That's a great year. And now I'm like, hold on, why don't I just have 20 bets and have an 80, 90% hit rate and have better tax consequence and have it for longer and have less headache and stress. And it's like, why are you going to get dressed 5 times a day, right? Get dressed once a day. It's just less work, and it's, it's the same outcome. So I'm doing what I love, and that's fun, and I'm sharing it with folks. And there's been a lot of folks that have been pretty appreciative of the research. So it's been a good journey, and I'm enjoying it.
Good. Well, that's great, and thank you so much for the comprehensive overview of your career. It's certainly one that so many young professionals aspire to, and I have so many questions. I'm going to try and pick the top few, because otherwise I think we'd be here for the next 4 or 5 hours. And I do want to come back to your podcast as well towards the end and just kind of learn a little bit more about exactly what the platform is and all of that. But the first question I have, I want to pick out a word. I know this is something you and I have talked about previously as well, but I want to pick out a word that you mentioned a few times just then, which is process. Maybe it is tying in Pitch the PM, your podcast a little bit here, but not only did you mention that Citadel and Millennium may have different process, but I know that you and I before have talked about as an investor, as a trader, having your own process or owning your process. Talk a little bit about what owning your own process means, maybe what, the North Star of your decision-making process might be defined as a trader, how you come to your decisioning, and the evaluation and analysis of the stock picking process using research, or of the research process, and A to Z of start to finish of deciding to push the button on making the trade. Tell us a little bit about process.
Yeah. So, process is really ingrained in you at Citadel. Like, everything has a process. It's not just your investment process. It's your risk process. It's your hiring process.
Yep.
Everything has a process. You evaluate the process, you look at the data, you figure out, how can I do it better? How is someone else doing it differently? How can I incorporate that? So it's kind of a living organism, the whole process concept. That's across businesses. And, you get to people who will say, hey, I made this much in a stock, or I had a great idea. I'm like, all right, but that's the output. Let's get into the input in the process. And that's what anyone needs, whether it's you're interviewing for your first job or you're trying to raise capital. The process is what's repeatable. So some sectors have different North Stars, honestly. And I've kind of expanded my types of sectors over time. To oversimplify it, I would say earnings revisions are the North Star. Okay. I would just say, all right, stocks move with earnings revisions. That's tangible. You can quantify it. You should have a reason that you think the company is going to grow 20%, the street's growing 10%. You should be able to have gathered good evidence, or have some sort of good logical reason build up to why you have a different view. So I would generally say earnings revisions, positive or negative. And then the question is, how can you do the research and find the evidence? And the evidence is a mosaic of things. It's interview and management, it's third-party data, it's industry supply demand, it's customers, and try to have that view on why you have a different view than other people. And usually when I say a variant view, it's versus consensus. And most of the time, consensus, or more often than not, it's usually what management says. They have, in theory, they have the benefit of the doubt, and they know the most of whatever they say, whatever they guide to. Most of the time, that's going to be what consensus is. And they have different agendas, right? They might need to have high numbers because they are on their back on covenants for the debt, and they know they can't, it's a stretch. Or they might be naturally conservative and they like to beat every time. So there's always little caveats on understanding what's going on with management. Where are they on different variables? Or sometimes they just don't know because they have to guide, because that's what they do. They do quarterly guidance, or they do annual guidance because that's what the street wants them to do. And
right. Yeah.
They tend to always undershoot versus the cycle, right? The cycle might have a 45-degree slope up and down, and they might always be guiding plus or minus 5%. And it just always happens to be better or worse. So that's why you kind of get revisions. And that's true in quant world too. A lot of those they'll look at, and that's probably where I learned that. I think I was on the sell side. I was in JP Morgan's office, and we were meeting with a PM, and he just wants to talk about earnings revisions, right? So that was like, I think he was kind of half quant, half fundamental, but that was part of his process. So you got to see a lot of different processes, long only and hedge fund when you're on the sell side marketing. Then you get to go implement it when you're on the buy side and create your own, right? You learn from other people, and now you got skin in the game. And if you're wrong, you don't have a seat. It's kind of that simple, right? The saying was, you get one bad year, not two. Or even later, I think there was at a holiday party for one of the big multi-managers, the head, the guy's worth many, many billions. And he gets up and says, it's December. You're only as good as your last trade. Thanks. Go make me money in January, essentially. So yeah, that was kind of my North Star. It does differ. There are times when, like NVIDIA today, you saw a little bit of a positive earnings revision last night and the stock's down. So cyclicals at the top and the bottom can have a little bit of a different process. And that could also tell you something, right? When the market's not reacting to positive earnings revisions, like you've seen for the last, at least NVIDIA, 2 or 3 quarters, that's one clue. Now, there's not one defining clue, because I just told you, earnings revisions. But if you look over the last 2 years, NVIDIA is up essentially with its earnings revisions. So it's also easier to bet on that versus a different multiple. That's a little bit harder to argue.
That's a really useful perspective, and maybe even as a amateur investor myself might borrow a little bit of that. So good, thank you. Next question, or next little topic I guess I want to talk about is research, which you talked about. Obviously, it comes a lot at the beginning of one's career, and is front loaded heavy into almost exclusively doing market research, or being an equities analyst or what have you. Is that something that you still are passionate about, is researching companies? And is that something that anybody and everybody who wants to get into trading, whether it's on the systematic side or fundamental side, do you believe that a research background is, no pun intended, fundamental or necessary in order to be successful?
Certainly on the fundamental equity side, yes. On the quantitative side, it'd be good to have a little bit of exposure so you kind of understand what other people in the market are doing. I have a little bit of quantitative exposure from being a Citadel and from running money at the Tulane Endowment through quantitative factors. So it's always good to know what the other people are doing and how that impacts you. But on the research side, yeah, I mean, it all starts with research. I mean, that's the secret weapon, right? That's the key. Knowing what to look for, knowing what's important to you, and studying a lot of the great investors. Now, some of that could be just the mentors who were 5 years ahead of you at Citadel and came from SAC, or the other your other friends at Millennium. I think it was more collaborative at Citadel, right? With the mentoring at Millennium, it's more decentralized. It's kind of your own little team, and there are more barriers around that. And that's what they want. They want uncorrelated revenue streams. So that's by design. And they both work very, very well. It's just different. Yeah, research is so fundamental, and it doesn't have to be complicated. Anyone can do it. You can start, reading 10Ks and stuff, and some, the PMs still do the research. I mean, Buffett was saying he's still reading 500 pages a week, and that's why he essentially hired, Combs. He's like, all right, if you want to read 500 pages a day, not a week, that's the job. It's just reading and doing research. And for me, I enjoyed that part more, making less decisions and doing the research and high conviction, maybe, a couple more high conviction ideas a year versus having to put all that together and run a book that's plus or minus 100 bips every day and try. I mean, they don't even want that. They want something that goes up at, 10, 50, 100 bips a day, or 100 bips a month. So like 10 bips a day, which is very hard to do. And at the end of the day, he's trying to be positive 50, 60% of the days. And, but that's just putting together, everything on top of the fundamental research. It all starts with the fundamental research.
So obviously, right, it's in the name, sell side and equities research or fixed income research or whatever the product or asset class research. The sell side is so well known for it, and it is the traditional career path, right? And you followed it, even if it wasn't at an international investment bank first, but you followed it sell side to buy side. Do you think it is kind of like the best way forward is to start on the sell side as some form of a research analyst? If your aspirations are to get to the buy side, again, fundamental or systematic, quant related, or do you think there is a world in which straight from grad school to the buy side, or do you think realistically you just can't get the skills without starting on the sell side? And I know from our experience and from our point of view in the market, the fact of the matter is the buy side loves to poach from the top performing sell side and top performing teams at top performing sell side institutions because of the skills that they garner there and because of the exposure that they get. So what's your take on that kind of career transition or career path?
I'm biased. I think, going to the sell side is a great place to start. You're deep in the models, you're learning the companies, and then it just becomes a different application. And at least when you're on the associate side, when you get to be more senior, now you're on the marketing side, and now it's a little different. But when you're modeling, it's pretty similar. And a lot of the, at least pod shops, are very domain constrained, whereas you're covering a lot of very closely correlated names. So that's the same way the sell side is lined up for their kind of, their research and for their essentially banking clients, right? Because that's kind of how it all flows, right? That's the expertise there, and so they can be value added. It's easier to be value added if you cover 40 of the same name versus 40 names in 10 different sectors. You're not going to be. It's just a lot harder to be an expert, right? There's more overlap and synergies with your time spent and your knowledge. It builds on each other, and the fact that domain knowledge is cumulative is super important over time. So yeah, I mean, if you can go directly, and now there's some programs that allow you to go directly, whether it's Citadel or the Point72 Academy, and there's a few others to the buy side. Kudos to you if you could get one of those. They're just much smaller percent of the people. But now these companies are so big and they're kind of institutionalized their talent flow a lot earlier to train them with the right skills and have them in-house earlier. And they really try and keep them, right? They try and find homes for them after, and really, they're trying to say, we've already spent a couple of years training you. We want to find you a team and do that. So the fact that they're bigger, they're kind of like these banks where they can start recruiting earlier and have talent longer. So I think it's a great strategy if you go right to the buy side. The sell side is also, if you love research, it's great. And I loved it too. I just, at a certain point, I wanted to be more performance driven than marketing driven.
Yep.
And it just depends on what your skill set is. If you want to be very sociable and you like, taking people out and, being the most popular guy and schmoozing management teams and traveling, it's great. And doing research. You also have to love the research too. But I'm just saying that you spend a lot of time marketing and a lot less time researching. You'll be saying, you'll have 2 or 3 names that you're talking about 90% of the time versus digging into a new name every other week. Right.
Okay.
And, when I was on the sell side, I was doing a lot more marketing. When I went back to the buy side, I was back to research all the time. So that's just was my passion. Just depends on your personality, really. I mean, and I think the other thing that has happened is the pod shops have just become so big, and they've done these searches so many times. It's picked over, right? They're picking over the associates at these banks so quickly that they started to have to develop their own talent because it just became bigger. The pool that they were poaching from became. Everyone, they had all these offshoots, and there were just more people. So It's great. It can be great. And a lot of times the sell side knows, hey, just come here for a couple of years, and they know that's you're going to go do the next pod at some point. People go back and forth too. Not less so at the senior level, because then you become, at the senior level, it's a little trickier to move. It's more at the associate level on the sell side that you're going back and forth. At the senior level, you kind of already built up your reputation and career, and it's harder to go back and forth. You kind of stay once you become those senior kind of, 15, 20-year career, II analysts. Those people don't tend to move back and forth. So, and you see movement to IR too, right? People kind of move between all the seats. And once they're in a specific, you have the domain knowledge, you have the finance knowledge, and they can all be rewarding. It just depends also where you are in your personal life and what you're looking for as well. So it's just a match, right? What your values are at the time.
It's so interesting because, and this is something that I've been saying for a while, and potentially, would be interested in doing a full episode specifically about this one topic. I know we've touched on it previously in prior episodes, but I think that the bar for talent on the buy side has raised so much. But I think potentially the impetus for that is the bar for talent on the sell side has been raised, right? There's so much more access to tools and education, and I'm a sports fan, so I liken everything to sports where I can. But it's like the developmental programs in youth sports are so much better than they used to be. So that's why today's professional athletes are better. That's exactly how potentially how this starts, and why the ultimately the bar for talent in hedge funds, and that's not just in the fundamental and trading space. We see that in technology, we see that in the quants and systematic and strat space. It's such an achievement to get a job and perform at the likes of the places that you've been and the likes of the places that we've discussed today, because the bar is so high right now.
Yeah, it is. I mean, when I did the summer internship programs at Citadel, and when I was part of the kind of recruiting class, we were, and this is when they were doing MBAs, and now that I think they're doing sophomore, juniors in college because they just want to train longer. I mean, the people that
literally, that's a great example. It used to be just recruiting, graduates and MBAs. Now they're starting them at sophomore and junior. So sorry to cut you off, but that's a great point. Even that right there.
Yeah, but just think about how much, that curve will be so much steeper, and they'll be so much further advanced at such, a younger age, because they
completely,
they're learning from the, even best and brightest people. And not that the people on the sell side aren't great. It's just you learn a slightly different skill set, right? You learn how to market. You're still learning some applicable skills, a lot of them, but you're also learning a little bit of a different craft. It's. I mean, the resumes, I would say it was impressive. It was humbling, actually. I mean, the schools and the MBAs and the projects, and I'm like, wow. I'm like, so definitely a high bar. But again, if you take a step back and if you really love it, you'll find a way to show that you have a real passion for that you're not just doing it because it's the highest paying job at the time, whether it's tech or banking or asset management. If you really love it, that will show. And then you'll want to work extra hard because you don't feel like it's work. And so it's, you don't have to be the highest IQ or the smartest person. You just have to be willing, you have to have enough competency, but you just have to be willing to love it enough to work hard. And you need a few breaks, find the right mentors. And, that's the key, is finding the right mentor. You might not have a choice at the end of the day, right? But if you want to go to certain places, but people say, what's the difference between all the different shops? And I'm like, at the end of the day, they're all, all these big 3, 4, even, go down to the spinoffs. They're all relatively the same. The most important thing is who's that mentor day to day that you're working with. Now you might end up working on a lot of these places. You'll be on a second team or a third team, and you want to be at a shop that has that, training and such. But that initial mentor day to day, who's gonna that you're gonna shadow.
Yep.
And someone has that time, right? You might be working for a great PM, but he's got 4 other people and he doesn't even have time to, really dig in with you. So that's the most important thing, more than it is any of the brands. That's one thing that people ask a lot. And
that leads me to what I want to be the final question just for today, until we get into our final segment. Whether it's mentorship or getting involved early, right? Early in college, or investing in middle school or high school like you started. What is a way, in your perspective, for the next generation of talent, either entry level, or junior now, or trying to break in the next couple years or so, can set itself apart? We've talked about a load of things today, right? Whether it's process or just being passionate about research or finding the right mentor. Are those the answers, or is there something else, maybe additional that we haven't touched on yet, that you might, be able to point to of a way for talent to be able to set itself apart moving forward, as individuals try and have successful careers in hedge funds?
Well, right now there's so much more information available to everyone, whether it's podcasts like this. There's so much else on Twitter, LinkedIn, and just detailed stuff that's, free and available. I think the one thing I look for that really sets people apart is, have they taken the initiative to teach themselves something? Have they...
Intellectual curiosity.
Exactly. I mean, and this is something that Ken talks about. He's like, I spent hours and hours at the Harvard Library teaching myself about convertibles. It wasn't in a class. It wasn't for a mentor. The knowledge is out there. Go teach yourself. And don't, in interviews, I don't want to hear about, I made so much money in a stock. I want to hear what was the process? What were the reasons that stock went up? Why were you attracted to it? And that's why I try and center my podcast around, this is the investment process that it's like steps that people can hopefully apply themselves, and just the detail and the rigor that each one goes through, and how it's a little bit different each time. I've had friends that are great investors, and I know they have a process, but if you can't articulate that process, like, you might know in your head how to make money and what sounds good and smells good as a stock and what doesn't, but write it down, see what it works, do your own feedback, and keep iterating on that process. So it's just teaching yourself something you're passionate about. That'll come through. And at the early ages, no one really has all the skills they need, or even close to them. You just want to be able to teach yourself, have the passion and the drive to keep learning, and you teaching your boss things in a couple of years.
That applies to more industries and more occupations than one. So that's a great place to put a bow on things here. I completely agree with that, and I appreciate your insight and perspective. So I want to wrap up with just our closing segment, and thank you again for being here. Thank you for everything that you've shared so far. So underhyped or overhyped is a little view I like all the guests to take. We've talked about investing. You've mentioned NVIDIA. It wouldn't be a conversation in 2025 if AI wasn't talked about. Investing in AI as a strategy, underhyped or overhyped?
I think the semiconductor part of it is somewhat overhyped. I think customers are calling it an arms race. So they're telling you, we're buying it just to be first before it's fully developed on what we're going to do with it. And it's just everywhere. It's just when things are all over the news and everyone's talking about it, you could probably say it's a little overhyped. You kind of want to go back to looking for stocks under rocks, things that people aren't covering. I think AI will ultimately be great for society. It'll impact a lot of things. It'll make everyone more productive. It's a huge step change, like everything was, whether computer, the mobile phone, the cloud, all these things were big step changes. This will be another one. I don't know how big. It could be bigger or small. I don't know. I'm just not one to, invest when it's been the talk of the town for a year or two. That to me it's hard to really make money in that sort of environment. Even though some of the companies like NVIDIA is an absolutely great company with great returns and they're going to sell a lot of chips over a long period, but there are probably you want to find the stocks that aren't covered, that are people have holds and sells on if they're covered at all. So then they're the next people to upgrade if the story changes, that aren't discovered yet, essentially. And in my AI journey, there's still some companies, the ones who are applying it to improve their margins, to improve their efficiency, the ones who are able to really crack the code on implementing the models and consuming all that infrastructure in a way that leads to essentially higher return growth and accretive growth. Something like a Meta kind of comes to mind there for me. What they're doing with their ads, that seems attractive, right? Just because I think that it's kind of, where are we in this AI kind of journey, right? Where's the value? Is it in semiconductors? Is it going to the appliers? Now, I'm not an AI expert at all. That's never been my super focus, but I think now everyone has some exposure to it, whether you're passive or not, and
even by accident.
Yeah.
Well, thank you. I'll be honest. I don't think we get a lot of overhypes. So that's a good. I'm glad we touched on this one. It's usually something is underhyped. So this is good. All right. So just to close out, I usually ask about what's obviously aside from searching smarter, what is a podcast that you're listening to? But let's flip that today. Tell us about Pitch the PM. What's a podcast that you're hosting these days? And then last question, what are some books that you've recently read or that you've liked and maybe what you're watching and that kind of thing? So floor's yours on that.
The Pitch the PM it's a podcast where I'm going through the investment process that I developed and was trained on and iterated on throughout the years, throughout both Citadel, Millennium, and thereafter. So I go through two different processes. One is kind of what I call the variant view process, which is pretty typical of a typical pod shop. And then I also, in my continuing journey to learn, I also have what I call a Berkshire process, which is a much simpler process. How are they thinking? I decode or reverse engineer some of the recent purchases that the deputies there have done on like Cool Corp or Constellation Brands. And I pretty much share that research. And here I'm only doing, one big one a month, one or two episodes a month of this deep research of names I like. And they tend to be more higher conviction because there's just less velocity of them. And, this is the research I enjoy doing. It's the research when I'm investing, what ends up happening is you cut corners, right? I might have had over the last 2 weeks, my friends might have pitched me 10, 12 stocks, right? And it's like kind of 2 sentences, right? But it's like, all right, let's actually go through the list and see why we like it, right? So I'm trying to, and it's been something that a lot of different people like, whether it's students, whether it's people earlier in their career to, a lot of the other, PMs that I used to work with or they're still colleagues, they like it. Sometimes it's usually for their PAs. Sometimes it's for their, they can't really talk too much about what they're doing in their books, usually in their professional books, but there's a wide audience there. And it's just kind of a passion project for me. And anything I do, I want to be the best at. So I'm implementing it, I'm doing the slides, I'm doing the work. And it helps me not cut corners myself by holding myself accountable to my own process. That's kind of the key for me.
I'm glad that you're able to tell us a little bit about Pitch the PM and any books you're reading or have read or recently.
Yeah, well, right now there's not much on my plate. Really all focused on Pitch the PM and trying to get that up and running.
Yep.
And my three kids. But I do share on the website. We actually just had it go live. We have a little library tab on the Pitch the PM where we listed kind of 10, 15 books that I've read throughout my career of people, everyone from Buffett and Munger to, Lynch, Greenblatt, Pabrai, Spear to other ones like Lewis. So those kind of, if you're a finance nerd like me, those are the sort of things that I've read and enjoyed that I'd go with.
Awesome. Well, Doug, thank you so much. A wonderful conversation with somebody clearly passionate about investing, passionate about financial services. So I'm really so happy to have had you on and that we got so much to talk about. So thanks again, and I will talk to you very soon.
All right, cool. Thanks.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.